Welcome friends, welcome back to our video lecture series. In this particular video, we'll be talking about the rules of debit and credit. The rules of debit and credit have been discussed in our previous video also, but the difference between that and this video would be earlier video was talking about the traditional method. Traditional approach or traditional method of the debit and credit for any transaction, or this was also the earlier method was also called as the golden rules. This particular video is about again the rules for debit and credit, but this would be to the modern approach, which is also called as the American approach. And as we told you in the last class that debit would always be equals to credit. Whether you follow the traditional approach or the modern approach, the rules would always be the same, or the result by following any of these approaches would give the same results or the same output, right? We know that the rule, in order to understand the rules of debit and credit, we have two approaches. One is the traditional approach and the other one is the modern approach. Traditional approach was discussed at length in the previous video with almost 8 to 10 transactions, I believe, wherein we have seen which account to be debited and which account to be credited and the logic behind that. And in this video we'll be talking about the modern approach, also called as the American approach. As we know that accounting is all about recording the transactions on two sides, and there are almost at least two accounts. Since we follow the double entry system, there would be at least two accounts in any transaction. And account is a place where transactions of similar nature are recorded. Say for example, if I say cash account, which means an account which would be recording all the transactions related to cash at one place. If it is land account, it would be recording the details related to land at one place. And we have also discussed that accounting is something which looks like a capital T, which means both sides of this account would be the same. On the left hand side we would be recording debit, on the right side we would be recording the credit. Again, you see, if you see on both the sides you have the similar type of things. On the left side you have date, on the right also you have date. Explanation would be there on both the sides, and similarly the amount would be there on both the sides. So as we know that debit is always equals to credit, which means in the account which is of a capital T format, you record the transactions having a debit implication on the left side and transactions having a credit implication on the right hand side. The modern approach would say that you need to segregate the accounts under five heads. One would be asset, the other one would be liability, third would be capital, fourth would be income, and fifth would be expense. We have discussed these terms at length in our earlier video, so if you are confused with that, I would request you to go to that video wherein we have discussed all these elements one by one at length. Assuming that we are clear about the meaning of the terms asset, liability, capital, income and expenditure, we are proceeding with this. So the modern approach says that you need to assume that the assets have a debit balance by nature. Similarly, the liability, being the opposite of asset, has a credit balance. Capital also has a credit balance. Income has a credit balance by default, and expenses have a debit balance by default or by nature. So what we know is, we know that the first one and the last type of account have a debit balance. These three would be having the credit balance. And when we say if an asset increases, since it has a debit balance, whenever an asset increases it has to be debited. The reverse would be for decrease. Similarly, when any liability increases it has to be credited. The reverse for decrease. Similarly, the capital when increase has to be credited, when it decreases has to be debited. Income when it increases has the same credit balance, if it decreases will have a debit balance. Expenses whenever they increase would be debited, whenever they decrease it would be credited. So these are the rules which we need to follow while we do the accounting, or whenever we are talking about the rules of debit and credit under the American approach. Which means you need to segregate whether a transaction is having an asset account or a liability account or a capital account or an income account or an expense account. Based upon that, we will see whether that particular account is to be debited or credited. And in order to make the understanding simpler, what we have done is we have taken the same example which we have considered while following the traditional method of the debit and credit rules. So in the same example, if I say that Mr. Aman has started a business with cash of 5 lakh, the first thing that we need to do is identify the two accounts. One account would be Mr. Aman's account or Aman's capital account, the same way as we have done in our previous video. The second one would be the cash account. The second step would be, first is to identify the accounts involved. The second would be the identify the type of account, whether it's an asset, liability, capital, income or expenditure. The name as it suggests is a capital account. Cash is an asset account for the business. Why is it an asset account? All the assets are those things on which the business has a right to use in the manner they wishes. So cash is an asset for the business. Whenever the cash comes into the business, the existing cash which was 0 would go up by 5 lakh rupees. So the asset would be increasing by 5 lakh rupees. And we know whenever an asset increases, by default asset has a debit balance. So whenever it increases, it has to be debited again. Automatically the other account would be created, or Aman's capital account would be created. If we go by the logic of the capital account, we know that the capital by default has a credit balance. So whenever it increases, it has to be credited. Clear? Looking at the next transaction, we said that Aman has opened a bank account, or Aman's business has opened a bank account with Axis Bank by depositing 10,000 rupees. Now what are the two accounts which are involved here? One would be the bank account or the Axis Bank account, and the other one would be cash account. What is a bank account? It is an asset for a business, because whatever we are depositing in the bank is our own property. We can use that property as we feel like, right? So asset would be, bank account would be the asset for a business. Similarly, cash account is also an asset for the business. One asset is increasing, the other is decreasing, which means my prior to this transaction the bank balance was 0. Now it is going up by 10,000 rupees. This is going up. Similarly, the cash balance was 5 lakh rupees. Say for example, this has gone down by 10,000 because we have taken 10,000 out of this and we have deposited that into my Axis Bank account. So the asset which increases would be debited, the asset which decreases would be credited. Luckily, both these accounts are of the same nature, which is the asset account, and the rules for asset account is whenever the asset increases, the account is to be debited, and when whatever asset decreases, its account is to be credited, right? Then we say goods purchased for 10,000. What are the accounts involved here? Goods account, or I would say inventory account. Some would say the purchases account. Whatever be the case, we will see that all these would give you the same result, and the other account would be the cash account. Goods and inventory are the assets, property of the organization. Purchase is an expense. If we talk about the asset, it has a general nature and natural balance of debit. Whenever the asset increases, whenever you buy goods, your assets go up. So when it increases, you debit that. Expenses also have a debit balance. If you remember, when the expenses increase, it would be debited. Other account would be automatically created. And if you see, if we look at the cash account, the nature of the cash account is that of an asset. The general rule for asset says that it has a debit balance. So because of buying these goods, my cash has gone down by 10,000. Whenever an asset goes down, the value of asset goes down, it is to be created. So this account would be created. Next transaction is sale of goods for 15,000. How does this transaction happens? You sell some goods, which means your inventory or your goods go down and your cash balance increases. This is also an asset and this is also an asset. Or if you consider this to be your income, the rule says for income the opening balance or the natural balance is credit. Whenever the income increases, it has to be credited. So whenever you sell something, you generate some revenue. So whether you go by this logic or this logic, the result would be the same, which says the asset which is going down would be credited, the asset which is going up would be debited. So I would say in this case my cash account would be debited by rupees 15,000 and my goods account would be credited by 15,000. And in accountancy we use this term as sales account. We do not use the term say goods account, but we say purchase account or the sales account, as the case may be. The next is furniture purchase for 25,000. Again we need to identify the accounts involved here. The accounts involved here are furniture and cash. Second step would be to find out the nature of this. This is of the nature of an asset. Again same, the nature of the asset. What are the rules for asset? Whenever an asset increases, it has to be debited. Which asset is increasing out of these two? The furniture balance is going up, the cash balance is going down. So this would be debited, this would be credited. Then you have purchased goods from Jaipur traders for 30,000. Accounts involved would be Jaipur traders, and then it would be stock or say purchases, or you can say inventory. What is the nature of Messrs. Jaipur traders? We say we have purchased goods from this guy, which means we haven't paid him. So we are supposed to pay this. It's an obligation. And we know that obligations are nothing but the liabilities for the business. So Messrs. Jaipur traders is a liability for the organization in form of creditors. And whenever the liability increases, it has to be credited because liability by nature has a credit balance. Similarly, when you say purchase or your expense, or if you say asset, the rule for asset is the general nature. By general nature they have a debit balance, so whenever they increase they have to be debited. Similarly, for in case of expense, by default they have a debit balance. Whenever an expense increases, they have to be debited. So under both the cases, this account would be debited and Jaipur traders account would be credited. Sold goods to Sandeep. Again, you have two accounts here. One would be the Sandeep's account, and the other one would be sales account. What is the nature of Sandeep's account here? It is of the nature of an asset. Why an asset? Because we have sold goods on credit. We haven't received money, but we have a right to receive that money in future. Right? We have a right to receive money from Sandeep. So anything on which we have a right are called as our assets. This is in form of a debtor. We have discussed this in our earlier videos. So the asset in form of Sandeep, earlier Sandeep's account was showing a zero balance. Now Sandeep has to be increased to 10,000 in form of assets. The asset which increases are to be debited. Similarly, the other account has to be created. If you see the sales account, it's a type of revenue or income for me. They have a credit balance, and whenever your revenue increases, it has to be credited. Or if you talk about the stock are of the nature of an asset. Whenever you sell something, your stock goes down. Even if you look by that logic, this account has to be credited. Paying salary of 3,000. What are the accounts involved here? One is the salary account, the other one is the cash account. Salary account, the nature of that is of an expense. Cash, again your asset. Expense has a debit balance, natural balance of a debit. Asset has a balance of debit. Salary is increasing. If debit is increasing, debit it again. Cash is going down. It has a debit balance. So it has to be credited. The reverse of debit. Whenever it goes down, it has to be reversed. If it's having a debit balance, we'll credit that. Next is paying electricity bill through check. What does this mean? It means you have a two accounts. One account would be your Axis Bank account. The other one would be your electricity expense account or electricity charges account. The nature of this would be of assets. This is an expense for you. If you remember, assets, both assets and expense have the same balance, which is debit by nature. So the balance in this bank account goes down because the bank has paid 2000 on your behalf. So whatever your balance was there in the bank would go down by 2000 rupees. So the thing which is having a debit balance, if it is reduced, what you need to do is you need to credit that account. Similarly, the expense has a debit balance, and whenever and this expense increases, so the thing which is having a debit balance when increased would be debited again. So in this way we would see that the rules of debit and credit would be the same whether you follow the traditional approach or the modern approach. So if you want to revise the modern approach, we would see that in order to find the rules related to the modern approach or the American approach, all you need to do is you need to find out these five things in your transactions. Then we know by default the balance of this would be debit and this would be debit. All the others would be having a credit balance. Whenever they increase, what you need to do is you need to repeat this. Repeat the same thing. How to repeat this? Debit, credit, 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 and debit. When they decrease, the reverse of this. What is reverse of debit? It's credit. What's the reverse of credit? It's debit. Reverse of credit, it's debit. Reverse of credit, it's debit. Reverse of debit, it's credit. So it's very simple. When you follow the American approach or the modern approach, all you need to do is you need to understand the meaning of these five, sorry, and then you need to understand that the balance of this and this would be the same, and these three would have the same type of behavior or same type of nature. So with this you get the 10 rules related to debit and credit in no time. Hope this clarifies the confusion related to the rules of debit and credit. Whether you follow the traditional approach or the modern approach, the result would be the same, right? Thank you so much and bye.